Hello and welcome to an FXTimes daily market recap. I'm your fundamental market analyst, Nick Nassad. Today is Tuesday, May 4th, 2010. The euro-dollar pair fell to a 12-month low in today's trading on considerable doubt as to whether Greece's government will be able to carry out the harsh austerity measures required in order to get its aid package. Moody's said that the EU IMF rescue package on Greece is not the end of the Greek fiscal crisis, as whether Greece can actually adjust its budget deficit in line with targets is key, and the markets right now are betting no. The solvency issue for Greece has not been resolved with the aid package. Greek capital requirements to 2012 are greater than the size of the bailout package, and that means that Greece will have to return to the capital markets after about 18 months. There are very big risks of contagion to other Eurozone debtor nations, and we saw the credit default the rates of credit default swaps for both Spain and Portugal shoot up today as a result. Also, the ECB bent its rules on collateral by allowing Greece to use its bonds as security despite their junk status. That could be a very big negative for the euro, as it means that the ECB expects the Greek rating to deteriorate further from the other rating agencies after S&P had downgraded them to junk status last week. So the ECB either takes up the risk into its own books, or it's the view that it can judge the situation more reliably than the rating agency. In any case, the credibility of the ECB right now is in question. Equity markets were rattled in today's risk aversion, as well as commodities. And as we saw, we fell below our low from last week, around 1.3110, and a very sharp 200 pip slide in today's trading. We'll see if the pair is able to find any support at this 130 level. However, with no clear resolution to the confidence or the lack of confidence in the markets for the euro, we could see it continue to fall past the 130 level. In this environment of higher risk aversion, falling equities and commodity prices, and rising yields on U.S. treasuries as a safe haven, we saw the yen also performing as a safe haven asset. In the euro-yen pair, we saw it slide from the 125.40 level down 270 pips to 122.60 by the end of the New York session. That came close to testing our lows from last week on April 28th around 122.30. We also are now at the bottom of this consolidation range that we had seen in this pair the last 2 months, or the last month. If the euro continues to be pressured, our next level of important resistance will come at the 121.50 level, so another 100 pips from where we are currently. This past low last week came after our sharp risk aversion as a result of the downgrades to both Greece and Portugal by the S&P. So we retest those levels after today's sharp slide as a result of today's risk aversion. While the yen gained very strongly against the euro, in the dollar-yen pair, we saw the yen gaining, but it did not move below this level of old resistance, which has now turned to support at the 94.30 level after we had a surge in the pair in yesterday's trading. Now, U.S. equities were battered in today's session, as we had the Dow Jones fall 2.2% or 250 points. The Nasdaq was off 3.2%, and the S&P 500 fell by 2.6%. Still, it could be a bit of a bullish sign for the pair that it did not recede further in today's trading when we did have such a big sense of risk aversion. We did have a couple of positive U.S. Fundamental reports, which we'll get to at the end of the broadcast. So those may have helped to support the dollar in the New York session. Taking a look at one of our risk-sensitive currencies, the Australian dollar, US dollar, we see the pair slide sharply in today's trading. That came even despite the RBA raising rates today by 0.25 by 25 basis points to 4.5%. It was the 6th increase in the benchmark interest rate in the past 7 meetings, but in the statement, the RBA did say that rates should now be around average levels. The RBA announcement was a classic case of buy the rumor and sell the news, as we did have a rally late last week prior to the announcement, but in the wake of the announcement and the dovish statement, we had a very sharp fall, which of course coincided with the increase in risk aversion as a result of the Greece Eurozone situation, as well as news over the weekend that China was raising the amount of deposits banks had to set aside as reserves to fend off inflationary pressures and to cool its economy. So all of those lined up to cause a sharp slide in this pair. Zooming this pair out, we see that we have fallen below our recent lows for this month, and today's low goes back all the way to March 29th. Today's environment of risk aversion even hit gold, which had been performing well the last 2 weeks, as we did have increased risk aversion over Greece. But in today's trading, after hitting a high near 1,192, we slid rather sharply to retest our levels from last Thursday around 1,166. Commodity prices overall took a big hit today, as the contagion worries within the Eurozone could mean a slower global economic recovery. Look at another commodity currency. Here we're looking at the New Zealand dollar, US dollar. We see a fall in today's risk aversion environment, though this fall of 120 pips was smaller than the slide we had seen in the Aussie, and we also didn't move through our recent supports. So here, this is the beginning of a correction to this rally that we had, and we could see that we did find some support at the 61.8% retracement level. But still, we have to keep an eye on how equities respond going forward, as well as commodity prices, to see if we have a further move down in this pair to perhaps retest our levels at the 78.6% retracement at 0.7150 or 100% retracement of this rally at 0.71. We have mentioned how equities had fallen around the globe and in the New York session, as did commodity prices, and oil was down 4% today, or almost $3.50 to $82.75. So the US dollar, Canadian dollar is the most sensitive to oil prices, and we saw the pair move in favor of the greenback and against the Canadian dollar, as we reloaded here at 1.001, our low from yesterday's session, and raised around 150 pips to trade at 102.50. This was the highest the pair has been since back here on March 26th, and we see that our high at 1.03 is a pretty important resistance level for this pair. So we'll see if we do come close to testing that pair, if we have a continuation of the risk aversion themes that we had in today's session. So while the fears of Greece and the ability of the Eurozone to contain the damage without contagion is dominating the Forex markets, it did overshadow some positive data from the US. Pending home sales for the month of March rose 5.3% as government tax relief boosted demand in the recovering housing sector. The index, which measures contracts signings on previously owned homes, is a strong leading indicator for existing home sales. And we did see existing home sales surge 6.8% in March, as we had pending home sales rise 8.3% in February. So today's reading indicates that we should see a strong month of existing sales for April. How the housing market holds up after that, following the expiration of the government's tax credit, will be a very important factor for the U.S. recovery going forward. Also today, factory orders for the month of March were up 1.3%, beating forecasts of a 0.1% or flat reading. That followed a better than expected February, in which orders were up 1.3% compared to the originally stated 0.6% rise. As we can see in the chart to the right, we continue to see a V-shaped recovery in manufacturing, and it did help to spearhead the recovery in the US, and it's a very positive sign following yesterday's very strong ISM manufacturing report that the sector continues to hum along as we progress with our recovery. The strong fundamental data we're seeing from the US is a sharp contrast to what we're seeing from the Eurozone. So if Friday's jobs number is also very positive, it could start to change a little bit of the dynamic in the Forex market, with the greenback strengthening on its positive news. But we have to see if attention will move away from the Greece crisis anytime soon. And a look at the upcoming fundamental releases for the next trading session. Tonight, the UK posts data on consumer confidence and shop prices, while Australia releases data on its services sector and building approvals. Overnight, the Eurozone releases its final version of services PMI, the UK posts its construction PMI, and the Eurozone posts its retail sales. Tomorrow in the US, we get the ADP employment change and the ISM non-manufacturing index. So that will wrap it up for today's broadcast. For more news, videos, and analysis, please visit our site FXTimes.com. I want to thank you for watching and wish you good trading.